In this video, I'm going to talk to you about sensitivity analysis in capital budgeting. Here's the idea. What is capital budgeting? Capital budgeting is us trying to figure out whether a long-term investment is worthwhile or not. And what do? We essentially figure out the financial cash flows of an investment, and then we'll say, okay, let's discount these financial cash flows. So we'll have some discount rate, and using these financial cash flows and the discount rate, we'll make a decision based on, say, NPV. So if the NPV of the project is, say, greater than 0, we'll say, hey, it's a good investment. Or for that matter, if we calculate the IRR of the investment and we figure out if the IRR is greater than the discount rate, then again, we say this is a good investment, and vice versa. It is very, very important for you to understand that at the end of the day, when we calculate NPV or when we calculate the IRR, these calculations depend on our estimates of the financial cash flows, which in turn depend on the ingredients that make up the financial cash flows. For example, we know that our financial cash flows depend on, say, how much we're looking to spend in capital expenditures. How much is our change in net working capital? How much are we looking to sell through our long-term investment, and therefore what will be our operating cash flow? The point being that our output, like you can think of NPV and IRR as the outputs, right? So these are the outputs, and this output depends on the underlying inputs that determine your capital expenditure, changes in net working capital, and operating cash flow. So sensitivity analysis is really just about how sensitive our model's output, like NPV, like IRR, to the underlying inputs. For example, if we have certain expectations about how much we will sell through this project or investment, and if the sales don't pan out that way, maybe we sell more, maybe we sell less, we want to be prepared. We want to understand, like, if we end up selling more than what we expect or less than what we expect, how would our NPV change? How would our IRR change? And this is just our way of preemptively understanding that, look, things can be better or worse than what we expect. And if those things happen, what will be the NPV? What will be the IRR? Because we want to be prepared. And so that's kind of the idea. So as I'll explain to you, when we talk about sensitivity analysis, our focus is on just changing one input at a time. What I mean by that is that when we have calculated, say, the NPV of an investment, say 1 million, okay, so let's suppose NPV is 1 million, and this is based on some sales level that we're expecting. With sensitivity analysis, we'll say, okay, what if our sales are lower than what we expect, or if they're higher than what we expect? But we don't change any of the other inputs or the other parameters that determine NPV. For example, we don't change costs, we don't change CapEx, we don't change the discount rate, we just say change the sales. Let's suppose sales are lower or higher than what we expect. Then how does the NPV change? So for example, if the sales are lower than what we expect, maybe the NPV drops to 800,000. Maybe if the sales are higher than what we expect, maybe the NPV changes to $1.2 million, okay? So this sort of analysis where we are changing only one input at a time, keeping others constant or fixed at their expected levels, that is referred to as sensitivity analysis. The question now is, how can you go about doing sensitivity analysis? There are multiple ways in which we can do this, but I'll show you an easy, convenient way in which you can do sensitivity analysis using Excel. So let's consider an example. So let's suppose that there's a company called Solar Air, and this company has developed a solar-powered jet. And they're like, okay, this is a great product. We think that we can go into full-scale production. So they're coming up with some estimates of, what the full-scale production will entail. Specifically, they feel that they will have to spend about $1.5 million in upfront capital expenditure. They expect that over the next 5 years, the size of the jet industry is going to be 10,000 jets per year. And they also feel that 30% of the market share they can capture. So meaning that the annual sales in units, in number of jets that they can sell, is 3,000 jets per year, which is 30% of this market size. The company further feels that they can sell each jet for $2 million. Their variable cost is going to be $1 million per jet. There are going to be some fixed costs associated with producing these jets, specifically $1.94 million. The tax rate is given to you. And you're also told that the upfront capital expenditure that this company will do, the useful life of all that capital investment is essentially 5 years. And we're looking to depreciate these assets using a straight line method. So depreciation is simply CapEx divided by the useful life. For simplicity, let's assume that there are no investments in net working capital that are happening. So net working capital and therefore changes in net working capital are 0. And you're further told that the discount rate is 15%. So what we are looking to do is figure out that, okay, using these inputs, what is the net present value and the IRR of this investment? So the key here is to realize that our NPV calculation and our IRR calculation, which is the output, is going to be a function of all these inputs. So the first thing that I'm doing here is actually figuring out or estimating the financial cash flows or free cash flows that we can hope to generate from this investment. And so in a separate video, I've talked about how you can calculate free cash flow as operating cash flow minus any capital expenditures, minus changes in net working capital. So essentially what I have here are revenues. Revenues that you're looking to get from this project is essentially the price at which you're going to sell each jet for times the number of jets. So that's 2 times 3,000 jets per year. Fixed costs are, well, they're fixed. They're fixed at $1.94 million. One thing that I would like you to note here, and this is critical, absolutely critical, is that I have a separate input section here. And when I am running my model here, in other words, when I'm doing my calculations here, I'm not hard coding any of the numbers. What I mean by that is that the fixed cost of 1.94, I'm actually cell referencing to this cell over here. What I'm not doing is that I'm not putting 1940 in my calculation directly. The reason that is important is because later on when we say, oh, you know what, our fixed costs could be different. Maybe they could be 2 million or 2.5 million. We're not scrambling to look for where did we put 1.94 in our model or where we entered our fixed cost. Because we know that all we have to do is just change this number to 2500, for example, and it will automatically get reflected everywhere in the model. And so this is very, very important for any financial modeling exercise, and I highly, highly recommend that you always do this. Always create a separate input section, and then when you're doing your calculations, try to minimize the number of values that you're hard coding in your model. Cell referencer calculations. The other thing that you may have noticed is that when I double click on this cell, it actually says fixed cost, which is cell referencing this cell right here. Normally what you will see instead is that when I click on like a particular cell, for example, it'll say something like G9 or G6. Actually, the name of the cell is stated right here in the top left. So for example, this cell is G6 and it says G6. You can always change the name of the cell. So for example, here, when I have fixed cost of 1940, technically this was originally B7. I said, I don't like this. I want to call this cell fixed cost. So I just went here and typed fixed cost like this. And that is what changed the name of this cell. Why did I do it? The usefulness of this exercise will become clearer a little bit later. Okay, so now we have our financial cash flows. And so the question is it a good investment? Is it a positive NPV? And so we can do this math right here. And so the NPV comes out to $1.5 million. And if we want to calculate the IRR is essentially just calculating the IRR of these financial cash flows. So this is simple command IRR, and that gives us an IRR of 52.83%. What is super important here is to appreciate that at the end of the day, our NPV and our IRR depends on these cash flows, which in turn depend on all of these different assumptions that we made about what our inputs will be. And so now we can talk about sensitivity analysis. For example, what if the market size is going to be different? What if we capture a different market share? What if we have a different price? So on and so forth. How would that change our NPV calculation, for example? So this is what I'm going to do. I'm going to create a table here, which essentially says, you know what? Let's take market size, for example. Yes, granted that I'm expecting market size next year to be 10,000 jets per year, but let's suppose that the market is not going to be as good. My pessimistic estimate is that market size is only going to be 5,000 jets for the entire year. If I'm being very optimistic, maybe it's going to be 20,000. So I have the best case scenario, then I have the pessimistic scenario, and then I have the optimistic scenario. The question that I'm interested in answering is, how would my NPV change if the industry size is only going to be 5,000 or 20,000? Now, the way that we have modeled our calculations, all you have to do is just say, you know what if market size is only 5,000 jets per year? You can easily do this and see that the NPV is actually going to be negative 2454. Okay, so 5,000 jets per year, and you already know that your NPV is this. And so, yeah, you can do this. You can go here and say, you know what, my NPV is going to be negative 2454. You can do this. This is fine. And in fact, for 20,000, which is your optimistic scenario, you can say, you know what, I'll do 20,000 jets per year. And if I do this, NPV is going to be 9,463 or $9.4 million, and the IRR is going to be 217. And you can just take this number, 9,463, and you can, put it over here. That's fine. However, there's an easier way to do this. Because as you can imagine, if you'd had several other scenarios, you'll always be going sort of back and forth, first changing the number here, then looking at the NPV and then putting that in here. And that's just market size. What if you instead wanted to do this exercise for like market share or something? So the easier way of doing this is as follows. You basically take this cell right here, okay, right below market size, and you say equal to, and you cell reference this NPV number right here. What it essentially is doing is it's copying the NPV calculation formula that you have here over here. So that's the first thing. The next thing that you want to do is actually start from this cell and highlight all of this area, like so. Okay, so all I did was took this cell, clicked here, and then highlighted this entire thing. Once you're done doing this, what you're going to do is this. You're going to go in Excel under Data, and you'll see What If Analysis. Click on here, and then click on Data Table. When you click on Data Table, it'll ask you what are you measuring in the row input cell and what are you measuring in the column input cell. Now, this is very, very important. This is a row. Right? And in it, you're measuring market size. Okay? So column is not important for you right here. In this row right here, you're basically putting in different values for market size. So you'll say row input cell, column input cell doesn't apply to you. In row, you're saying, you know what? I'm putting in different values for market size. And in my baseline model, the number of market size is basically coming from here, right here, 20,000. This is the market size number. Okay. Once you will do this, what Excel will essentially do is that because it knows that this NPV formula is using cash flows from here, and these cash flows are in turn a function of the market size number that is coming from here. When you highlight the cells in this way, Excel understands that you essentially want Excel to go and change the market size numbers to 5,000 and then 10,000 and then 20,000 behind the scenes in this NPV formula, so that when you'll press OK, it'll just show you what the NPV number is going to look like in these different situations. So it has already behind the scenes done this math where it's telling you that, look, if your market size were instead 5,000, then the NPV is going to be negative 2454. For 10,000, it's going to be 1518 and 9463. And you can see 9463 is matching with 9463 here. Why? Because, well, right now we're using 20,000 here. If we change this to 10,000, which is our baseline, then our NPV is 1518. And so this is a convenient way of doing sensitivity analysis, basically through what we call a data table. So let's try and do this one more time. Okay, this time instead of doing it for market size, we're going to do it for market share. So in our baseline model, we said that, look, our market share will be 30%. And we did our baseline calculations based on that number, and we have an NPV of 1518. But what if we're interested in knowing, what will our NPV look like if we're only able to capture, say, 20% of the market share, which is the pessimistic situation? Or in the optimistic situation, what if we're able to capture 50% of the market share? And so again, yes, granted, all you need to do here is essentially change this number to 20% and see how this output changes right here. You can also do 50% and then see what the output change will be right here. That's all fine, but a much easier way of doing this is to say, okay, right here, I'm going to do the exact same thing that I did earlier. Okay, I'm saying equal to NPV formula right here. Okay, so I'm essentially copying the NPV formula over here. Once I do this, this is how you need to proceed. You need to click where you just copied the NPV formula. You're going to go all the way from here till the end of this sort of section. Okay, and then again, you go data, what if analysis, data table. Now, again, in this row, you're capturing different values of market share. So in your row, you have different values of market share. You say, okay, column doesn't apply to me. In the row, I'm basically measuring market share, and my baseline number for market share is coming from right here, 30%. Okay? And so once you will do this, again, Excel behind the scenes will essentially say, okay, I know this NPV calculation has been done using the market share number that is coming from here, but what if I go behind the scenes and change that number to 20% and then 30% and then 50%, and it'll output the NPVs corresponding to those values of market share. If you don't believe me, just press OK, and lo and behold, you have these different values of NPV corresponding to these different values of the market share. And so this is something that you can do for literally any of the inputs here. You can have a pessimistic number and an optimistic number for any of these inputs. And so this is what I'm going to do next. So if you take a look, I've determined different values for price per unit, for variable cost, for fixed cost, for initial investment like the CapEx. Our baseline number was 1.5. What if in the pessimistic scenario is 400,000 more? Or in the optimistic scenario, maybe it's 500,000 less. So this is showing you how your NPV would change. Notice, and this is extremely important, is that when we're doing sensitivity analysis, we're only changing one number at a time. Okay, and so this is showing me how my NPV would change. If I wanted to present this a little bit neatly, what I can do is create a table right here, which just shows me market size, market share, the different inputs and their pessimistic and optimistic, and then the best case situation. So all that I'm doing here is actually just self-referencing back to the NPV calculations that I've done over here for different values of market size, market share, so on and so forth. This is the exact same table that I'm showing you over here. Again, the idea is to show you what sensitivity analysis looks like. Now, sensitivity analysis, I hope you can appreciate by now, it's useful. Why? Because A, it can help reduce the false sense of security that you can get from a positive NPV project. So we tend to do this often. We'll do a capital budgeting exercise. We'll say, hey, our project has positive NPV. This is great. Let's do it. But what sensitivity analysis allows us to do is say, look, our inputs can be different from our expected or baseline situation. So what happens in that case? And so, for example, with market size, you can see that while in the best case situation, yeah, it's a positive NPV project, but for some reason, if the market size is not that large, we know, or we can see that this could very well be a negative NPV investment. And so this false sense of security that this 1.518 can give us, once we've done some sort of sensitivity analysis, we can say, hey, you know what, we've got to be careful. This may very well turn out to be a negative NPV project, and you become a little bit more careful with your due diligence. And in fact, that brings me to the second point, which is that sensitivity analysis can motivate you to do a little bit more digging into your research. What I mean by that is this. When you look at how your NPV is changing with market size, and you can see that it could be way negative, you're like, okay, we better make sure what the market size is going to be like, because we know that any small change or any change in that expected situation, if it actually becomes pessimistic, we could be losing a lot of money. And so that is exactly what the sensitivity analysis allows you to do. However, this sort of sensitivity analysis also has some disadvantages. So here's one. Sometimes it can actually increase the false sense of security from investing in a project. What I mean by that is this. Take a look at the price per unit. We are looking to sell each jet for $2 million per year. And we said, hey, well, even in a pessimistic situation, we're going to have a positive NPV. Like even if the price is 1.9 million, it's fine. But you think that the most pessimistic number that you'll have for jets will be 1.9. In other words, you came up with the notion that even if you're being very pessimistic, very conservative, you'll be able to sell each jet for 1.9. But what if you're wrong? What if you're wrong? What if you can't sell the jet for 1.9, but maybe something like 1.5? The point that I'm trying to make is that when you come up with the pessimistic and the best case and the optimistic numbers, and when you look at NPV and it's positive all the way around, you're like, hey, I did my sensitivity analysis. This is a great project. It's positive NPV. But maybe you didn't choose the right numbers for the pessimistic or the expected or the optimistic situation. And so in that sort of a situation, it can sometimes increase this false sense of security. And the other major disadvantage of a sensitivity analysis, and I'm sure you've got this by now, is that you only change one input at a time, right? So when you're doing this analysis, you're only changing market size, keeping everything else constant, or just market shares, keeping everything else constant. But sometimes you can have specific scenarios in which you might expect all the numbers to change at once. So for example, if there is a financial meltdown, or if there's an economic downturn, and the entire market size reduces, and on top of that, you're not able to capture that much market share, and on top of that, the price that you can charge for each jet, maybe that goes down. Well, you're not capturing that scenario here, okay? All you're doing is just changing one input at a time, keeping others constant. And so in order to overcome that deficiency of sensitivity analysis, we have something called a scenario analysis, and this is something that I'll talk about in a different video.